So as I said, I got a couple comments from conversations I've had with some people. I've got a few interesting factoids I want to share, and I want to talk about basically how what the market is discounting when it's pricing the way it's pricing right now. The biggest conversation I've been having, and I'm sure Scott and David and John are having these conversations as well, is why after the fastest downfall that we've ever seen in the market did the market recover so quickly, even as the economic data was getting worse? Like, why does that make sense? And a recurring theme of some of these conversations that I'm having has been that I keep trying to remind people that the market is forward looking. What that means is the market is looking for expectations. The market is trying to figure out what's going to happen next. And so that deep decline that we saw is kind of normal when things are unknown, when uncertainty exists. And there's a well-documented history of recessions and the timing of calling of recessions. And we won't be able to call this, we know this is a recession. We won't be able to call it a recession, or the National Bureau of Economic Research won't call it a recession until they've confirmed that we have 2 quarters of negative GDP, right? And so over the last 80 years, the equity market has turned up on average about 107 days before a recession ends, okay? But of course, the practical reality is actually far worse than that, because we don't know when a recession ends until long after that, because we're waiting for the National Bureau of Economic Research to tell us when it ends. So, quick example, in the 2008-2009 crisis, the market bottomed on March 9th. That's March 9th, 2009. And the S&P was up 36% by the time the recession was called, okay? So 36% recovery in the market by the time the recession was called. But the National Bureau of Economic Research called it, but they called it long after. So it was called on June, something like June 10th, 2007. It was said to be, or sorry, 2009. It was said to be over. But they didn't call that until months later, until September 21st. By the time September 21st came along and they kind of called it, we got confirmation, the markets were up 60%. So this is the market always looking forward. And even then, we're talking September 2009, nobody believed that it was over. Right. Everyone believed that it was still going. And in fact, you might remember there was a press conference and Obama was saying, hey, the recession is over. And everyone shouted him down. They yelled at him for it, that no one believed it. So one of the most critical missions that we have in a time like this, whether it's a V recovery or a U recovery or a W recovery or a square root shaped recovery, whatever, we have to recognize that it is unknowable how it's going to look when the recovery comes, and irrelevant to a long-term goal-focused investor. All that should matter to us, those of us who are long-term goal-focused, is the inevitable fact of the eventual recovery. We know it's going to recover. It's an inevitability. Therefore, we hold on and we do those actions we've talked about in the past. So I'm gonna just stop right there really quick. I'm gonna ask that somebody, I always do this, put a question up into the Q&A so I just know it's working. And then I'm gonna see if any of my other panelists want to say anything about that, or about have any other comments. I have some more things to say, but I want to open it up for everybody else.
I don't know that I'm able to actually ask questions in the way it's asking. I thought there was a really interesting article, or a doctor that was interviewed. I don't know if you saw it. I sent it to you over the weekend, and he was talking very specifically about the countries like Norway, I think, and Sweden, that didn't do anything like we're doing, and their actually death rates are very similar. And so I think we're going to be hearing more and more about this. And he talked about how when a baby comes out of the womb, they have there's no immune system at all. And when they touch and they do this, they're building up all these antibodies and immune system. But when we're being put in homes and not out in the world, fighting off all this stuff, our immune systems are dropping. And so I think it was a really interesting piece with this, this infectious disease guy talking about the science. I'd not ever heard anyone talking about it like this before. So I thought it was really interesting that there are countries out there that have done nothing like this, and their death rates are very, very similar to everyone else in the world that's doing this. So,
Yep. So a couple additional quick things. We always talk about how emotions move us to take action. And when markets go up, 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 whether that's end of the 1990s, in anticipation of the changing economy relative to technology and the dot-com era, or that's the market in the real estate world going up in 2006 and 7 with all the lending and all the free money that was pushing that up, or when things go bad and we all pull money out of whatever it is there. You can actually see in the money flowing from different sections of the investment world, and you can kind of see how people are responding. And so March, we set a new record in March. There were $790 billion in March was moved into government money market funds.
wow.
That is all. It's just bumping up against $1 trillion, and that's after the market collapses. And so the market collapses, a whole bunch of people pull money out of their, whatever their investments are, and they go to cash because they're terrified. And the thing that say, well, Jonathan, what do people pay you for? It's to keep people from doing that thing. Like there's lots of things, a lot of details, help people set up their 401k, their financial plan, model it all out, think about it, make decisions on specific things. But where we really, I think, make a huge difference in people's lives is at both extremes of emotion. When emotions are high and people are saying, and they say this all the time. Remember, we had people come to the office when Bitcoin was at 20,000 saying, hey, we should buy this now. Bitcoin's never been there since then. It collapsed within a quarter. That same was happening in .com. I was having those real estate conversations in 06, 07. Shouldn't we put all of our money in this? And it's an interesting challenge, that emotional piece.
Cannabis a couple of years ago, same thing.
Yep, same thing.
Stopped going up, and now it can't go up anymore. Yeah.
So I have a panelist raising their hand. David, do you wanna comment on something?
No, I did that by mistake. Sorry.
Okay, that's awesome. I love technology. Okay, so another little factoid here is, and these are 4 really good indicators of how things are. These are going to be leading. These are the indicators that let us down, and they're going to kind of lead us out to a large degree. Here's the 4. 1, TSA checkpoints. So you guys know this, right? When you go to the airport and you fly, you go through a TSA line, and there's a checkpoint to see how many people are going through that line. And these went almost to zero, which completely makes sense. No one was going through the TSA checkpoints. No one was flying. Those have, in the last week, have begun to pick up again. We're still 90% off of where we were, but people are starting to fly. Year on year changes in dining in restaurant, everywhere in the country was off 100%. Now there's a few states where we're seeing a few states that are picking up. So we're still down 90%, but we're still seeing people going out for the first time, testing the waters, trying stuff out. The third one is gross movie sales. Those have not begun to show any life at all. They're off 100%. They're going to stay off 100% for some time. And then the last thing is hotel occupancy. And this too is beginning to pick up, and it's kind of state by state. But those when we see the recovery begin, we're going to see those 4 things begin to pick up. And when the recovery is done, when we know that we're recovered, those 4 things will get back to normal. And go ahead, Scott.
Yeah, we've got a question and some comments coming in here, so let me read that. I'm confused by reasons given for market behavior. NPR says it's down today because of relations with China. Why this and not oil prices or virus deaths or unemployment rates, etc.? Who decides why this is noteworthy, and what does one do with this information? That's a fantastic question. It really is. It's a great question.
Go, Scott, take it.
Well, I mean, I've said this on these calls before. I've been doing this a long time, and some of you folks have been on the call, have been involved in the markets longer than I've been. But you get to really pick and choose whatever you want and say the market went down today because of X and point to these 5 reasons, or the market went up because of Y because of these 5 reasons. The market's going to do what it's going to do. And I've been around long enough I've seen markets where a company comes out with great earnings and the stock plummets 20 points. And I've seen a company come out with horrendous earnings and the stock goes up 20 points. And so the market doesn't always behave just based on some news around deaths or unemployment or oil. And I think it's almost a way in which I think the media manipulates information to feed to the narrative they're trying to create and sell to the public. So I think it's a really good question. I think we get caught up too much in trying to title why something went up or down. And I think the real reason why something went up or down is because somebody bought more shares today or they sold more shares today. And you could always attach meaning to it, but that's up to you. And that's been going on since the beginning of time. But I'm sure, Jonathan, you could add to that, of course.
Yeah, I think that, something that you can do to kind of defray or to sidestep a lot of the commentary that you see out there is listen to a variety of sources. The more of us that just end up listening to or reading the same thing, we're getting one message, and Alex Scott said that message it's not pure. Like the message of any media person has their own filters. Right. And those filters stem from their beliefs, and they have the same amygdala that we do, and their amygdala determines what information gets to them that seems important that they use in their stories, and what information they don't look at. So it's really, really, really important to actually get information on these things from lots and lots and lots of sources. So if you watch NPR, also read the Wall Street Journal. If you're on one blog, read another blog that's going to give you the opposite sense of things. And this isn't because I'm saying one's right and one's wrong. I'm saying everything is biased. Everything in the media, it's not that the media is bad. It's just media is human. And humans have these very innate issues when we're processing information. We are filled with cognitive and emotional biases that create these news stories. This is why I said when we started this off, one of the things I talked about was that what we have to believe in as long-term, goal-focused, planning-oriented investors is we have to believe in the inevitability of the recovery. And it's inevitable. You can look at a mountain chart that goes back to 1924, and it goes through the Great Depression, and it goes through, 20 different recessions since. And every single time, the unifying factor is we figure it out and we get past it, right? The recovery is inevitable. The eventual recovery is inevitable. How we get there, we don't know. We don't know. That's impossible to know. But you don't have to know to believe in the long term. And I think that when we listen to Warren Buffett over the weekend, that's how he has built the wealth he has built for him and all of his investors and anyone that's put money in Berkshire Hathaway. Is he did not get scared when everyone else was scared. In fact, he looked at that as an opportunity. Scott?
I was going to we had talked about this. I'm not sure if it was on one of these calls. We talked about it in the last couple of months. Susan Krakauer, who, in terms of media, and I think that the question here, who decides what's newsworthy? To Jonathan's point, I think CNBC makes their decision based on somebody in some ivory tower. Fox obviously makes their decision by somebody in their ivory tower, so on and so forth. I think it's not a lot of people on this call, but I think it'd be good information for you guys to hear. So we had discovered, and I had no idea about this kind of thing. We had discovered a woman by the name of Susan Krakauer, was actually the head of all business development and programming for CNBC for about a decade, coming out of the Great Downturn. And so you say, who is this woman, Susan Krakauer? I kind of said the same thing. Here's what we learned, and this is fun in 2020. You just Google search. She used to run programming at the Maury Povich Show. She ran programming at Sally Jesse Raphael. And then my personal favorite, again, she was a dozen years at CNBC. They plucked her from this. I think her crown jewel, other than those two, she was running Jerry Springer's programming. And so you got to just stop for a second and pause and ask yourself, what does CNBC have any business bringing someone like this in to report facts and news? And the answer is, and if you do some research on this, you'll find it. She's there to get eyeballs to look and to watch and create action, activity, and shock. And there is a video online you could find as well where she literally says in this interview, when when we started running Mad Money, I told Jim Cramer, and I'm quoting her now, I need him to seduce our viewers. News isn't there to seduce anybody, guys. So to your question, who decides what's newsworthy? Your guess is as good as mine. I just know for about a dozen years, this is who CNBC had behind the scenes. I just thought I wanted to put that out there because it's one of my most exciting morsels of random information I found out in the last 12 months. It is just shocking, really shocking.
Juicy.
Yeah. Well, but the fact is they can't say with regard to market movement, well, we don't know. That's not the answer that they can ever provide.
Well, you'll just turn the channel. You'll turn the channel if they say that.
Yes.
That's not the answer they can provide, but that's just exactly what Warren Buffett said yesterday, and I wrote it down. And he says, I can't predict what's going to happen tomorrow, next week, next month, next year. I just can't do it. But his advice was, and it was very interesting. I listened to most of the call. I didn't hear him talking anything about investing outside of the United States of America, which is not, I don't think that's such a great idea, but I'm not Warren Buffett. But he does say, if you're going to invest, you've got to own a cross section. You just don't bet on one thing.
And he provided, I mean, he sold all of his airline stocks. Like, I don't think.
Well, the very interesting thing about Warren Buffett is I have never, ever heard him gloat about any success, but he's never afraid to admit that he's made a mistake. He'll come right out and say it.
Very true.
Yep, that's true.
Great point, John.
That's true. So in this idea of, well, first of all, the Q&A function is there, the chat function is there. By all means, pump things into there, and we can get to your specific questions easily. I want to talk about expected earnings. So corporate profits. We're looking forward. Where do corporate profits come from? And there's an equation. I forget the economist that did this equation. It wasn't the ones it was a name I don't remember. Anyway, so here's the equation: something like this. It's corporate profits, expected earnings come from current investment. So companies that are investing in innovation and productive capacity, dividends and buybacks. So that's investment plus dividends and buybacks minus savings. So this is savings is money that employees don't spend. Minus government savings, which is rare. We don't see that anymore. But the level of the government spending makes a huge difference. And then minus global savings, which is money everyone else isn't spending. So the thing that actually detracts from earnings and corporate profits in all of its locations and all of its spaces is savings. And so it's true that right now, dividends and buybacks are going to go way down. And it's true right now that investment in capital and equipment and productive capacity innovation is going to go way down. But it's not going to go down 100%. And this is where it gets really interesting. The government deficit in 2020 is going to be about just under $4 trillion. And I don't think people grasp how enormous that is. It's like 75% of all the investment in dividends and buybacks combined, right? So that is an enormous stimulus, or recovery, or backfilling the hole, or whatever you want to call it. And this is why I think in large part people are looking at this as, okay, there's enough money here to fill the hole. and we still have to go through it. Like, there's enough money there to fill the hole, but we still got to go through this whole process. And this whole process is going to involve looking at the next quarter's data, maybe 5 to 6 months of data, which is going to be horrendous. But again, as we started off, markets are looking forward. The last 2-3 days, we've had 2 or 3 days of negative, which is fine. That doesn't bother me at all. I think we said in last Monday that the idea of retracing and maybe retesting lows, that's normal. I do think that the low is in, but we may go back and visit it just to make sure. But the market's looking forward. The market's looking forward to these earnings, and it's looking forward to this fact that we have just pumped a ton of money into the system, and we are continuing to talk about pumping more into the system, and we're starting to see the green shoots in those 4 places, all but movie theaters, like restaurants, travel, hotels. These are still way off their highs, but they're better than they were, which was 100% down. And as states open up, we're going to see more of those. And as we hear the information that Scott was talking about earlier about Sweden and Norway and places that handled it differently, that's going to put pressure on us on how we're handling it. And so we're going to change. And this is it's a massive experiment on how to handle it. And the more we realize that the data isn't dependent upon what we're doing, that's going to be more pressure to open things up faster. And I think that we're in a good place in the state of California. I think that there are way more data and science dependent, but we're gonna be pressured by other states that are doing it more quickly. As they save their economies, we're gonna be pressured, and Newsom is gonna feel that pressure.
Mhm.
No question about it. Scott, you have something?
No, that's 100% correct. I'm not a name dropper, but I do know someone who happens to be working in the city in a pretty high place, and they're getting a ton of pressure. They're not going to be able to wait till the end of May to loosen up. There's no way, is what he's telling me. And they've already started to announce certain things. That I think another announcement came out over the weekend, more to come this week. And I'm hearing 25% of restaurants, and just a lot of stuff coming. And they're just not going to be able to wait until June. It's going to be very, very difficult. And I was out this weekend, not in a unhealthy way. You're really bumping up against society that doesn't want to wait either. So you have to, it's just not an easy decision to make, weighing the economy and the health and wellness of your state and your constituents. But there's a lot of people out without masks, unfortunately, and a lot of people not social distancing. And I don't know what the happy medium is. I'm glad I don't have to make the decision. I'm still going to be super safe and wear my mask accordingly and stay away from folks. But yeah, I just don't see this making it till June from this London breed for sure, and we'll see what Gavin Newsom does on the state level.
Yeah, I think it's, and we talked about this about a month ago, but I think there's something you said there is really, really important. You said I'm going to still be safe. I'm going to still distance, and I think at the end of the day, we whatever the governments do, whatever they open up, whatever they say is okay. I don't think that if we suddenly had a green light from Gavin Newsom and he said, okay, I was wrong about that. May 10th. We're going to open everything up. It's not going to take off right away, because we're all going to make a choice. And I'm not going to go sit in a restaurant with 100 people. It's just not going to happen until I have a vaccine, right? When I have a vaccine, I'm going to be good. And on that front, I mean, I'm sure everyone's reading this. There are 3 or 4 really good candidates in the vaccine space. We're still having a really hard time, because I think they allowed way too many options to be available or sold in the market. We're having a hard time putting the tests out there that can actually successfully, with a high percentage of success, accurately determine who's got antibodies. I don't think that's been resolved yet. But the vaccine is actually well underway. It seems they've already started human testing. And this is great. And 4 different places, 4 different companies are doing it. And I think the group out of Oxford is leading the charge. I think there's also a Chinese company that's very successful as well. But yeah, I think once we have the vaccine, I'll have no problem sitting in a restaurant if I know I'm safe. But until then, it's going to be an individual decision after the government says, okay, go ahead. When Gavin Newsom gives us the all clear, we're all going to decide whether we're going to wear masks and whether we're going to go out and social distance or whether we're just going to stay at home. And we're talking about what are the steps, and John is actually bringing this up, brought it up last week. He said, so what are the steps that we need to go through to go back to the office? There's an elevator there. How do we feel about riding an elevator was my question. What do we do in the office are we meeting clients in the office when it's all open, or are we still doing Zoom calls for a while? Is that something that we're going to determine, or is that something that we should get feedback from clients on? And I'm happy to do Zoom. This is fine for me. But if clients want to come in and see us, how do we feel about that? And it's just something we're all going to have to figure and take the steps and kind of go through it. I think it's not going to be easy.
It's very interesting. As I walk up and down Solano Avenue, many establishments, restaurants, when the shutdown first happened, immediately locked their doors. Others did not. Others went the takeout route and have been actively marketing it, through Nextdoor, through other channels out there. But all of a sudden, this weekend, several restaurants that had shut down immediately on March 16th, all of a sudden they're opening for takeout. And I found that kind of hard to believe. Why did they shut down in the first place? Or since this has gone on now for 50 days or so, do they feel better about reopening for takeout? It's very interesting. What maybe to Scott's point, do they just feel better about things and they decided to give it a shot? I don't know.
And they're not allowed to do in-room dining, so it's all takeout.
No, they're not.
Yeah.
It's all. But I guess I found it strange that other places did not shut down.
Yeah.
They immediately went to takeout, whereas these other restaurants shut down immediately. Now, over the weekend, they decide they're going to open up for takeout.
Yeah.
I couldn't figure that out. And maybe it's because they feel that the worst is over. I don't know.
Yeah.
Scott, you have something?
I just think that what John's saying, I think that people, both businesses and individuals, are just getting a little bit more comfortable than they were a month ago, several weeks ago. I'm not to say there's still not sickness and people are still dying. That's happening. But if you remember, it's hard to remember because it's so recently, what it was like just several weeks ago, it was really dire. And people were petrified. I was once I got on board, I was pretty scared. I didn't want to be meeting anybody new. I didn't want anyone coming to my house. I didn't want to go to a restaurant. I mean, I was ready for this thing to tell me when I'm ready. And what I'm seeing now is, and I'm not being callous to the fact that people are still getting sick and dying, but for a state of 40 million people, there's only a couple thousand people that have gotten sick and actually died. That percentage-wise, it's really not what they predicted by any means. And so there was a time where they were talking about 1 million, 2 million people in this country were going to die. So we forget this, and I'm not saying that people are passing. This is still tragic, and it's very sad, but the numbers are nothing like the worst case scenarios they were talking about. And I think people are just starting to come to realize we're going to get through this, and somebody has to open their door. Someone has to start, even if it's the states we don't agree with what they're doing. Someone has to be the first one to say, let's try this. Let's believe in, through the smoke, what's on the other side of this. And I think that's what John's saying. He's seeing some stores and restaurants saying, let's give it a shot. Let's see. They can always close back up, but I think they're slowly adopting the fact that it's not as bad as we all thought, although it's still not great.
Yeah.
If that makes sense.
I actually wonder, and this is, if you think about all the businesses that applied for federal aid, and I think the first tranche has gone so quickly that maybe people are receiving part of the second tranche. And then in order to get forgiveness of the PPP lending facility, you have to have employees that you're paying. So that could be part of the stimulus as well. It's sort of a rock and a hard place though, because employees that are in a restaurant or in a retail environment, or in hospitality or to some extent construction, you're getting paid more not to work right now than you were getting paid to work. And that's so the incentive to go back to work is actually pretty light unless you're getting some kind of a bonus or a hazard pay of some kind to come back to work at this point. But I think that may be one of the things that's pushing the businesses that, this last weekend, and one of the things that's going to push businesses over the next couple of months to open up is because it's a requirement of PPP that you have people you're paying, and it's tough to just pay people just to do nothing, though that's what many businesses are doing. They're choosing that. But maybe just open up a couple employees, open up for some takeout. Maybe that's easy. And also, there's a point where you just want to get out of the house, and maybe the owners are just like, you know what, I'm going to go and I'm going to be the chef, and I'm going to cook something up, and we'll do takeout just because I cannot stay at home anymore. And I think that's just as valid.
Maybe Jonathan, share with who's on the call some of the small businesses that we know that have actually received some of this, that a month ago things seemed to be really dire, and now they've got this sort of oxygen mask and some runway to get up and running again, and the kinds of businesses and so forth. Maybe mention some of that.
Yeah. So I mean, we're working with. I've had pretty lengthy conversations with 4 or 5 different business owners, and we're talking, painting, contracting. I'm talking retail store, garage, somewhere you get your car worked on, a law office, and so say again.
A nursery, of course.
Yeah, nursery, right. So yeah, and so we're actually working with them, and they're trying to figure out how to do something in this environment that's going to benefit the business long term. Hire enough people, pay contractors. So here's a variety of things. One of the guy that owns a retail store, his people aren't coming back to work because why would they? They're getting way more money on unemployment than they do working in a retail game store. So what he's doing is he's hiring contractors, and they're building an online store. He's had like a really rough, kind of a crappy online store for years, but he's going to spend $20,000 or $30,000 with contractors to build this online store, so that he can start selling in this environment and have it delivered. He's also hiring some contract marketing people. How do I present, or how do I create an environment where I can do a gaming classes or run different games, or teach kids how to play these games in schools, or how do I reach out into the community to increase the size of my the folks that are the geographic area that people come to us from. So that's one example. Another example is we've got some contractors who are saying, hey, how about we give a discount to people who want the outside of their houses painted, and if we give them a discount, then maybe we'll be able to push some business into the next couple months and paint the outside of somebody's house. They'll get a discount. I get to keep my people employed, and I get it forgiven by the federal government in the PPP. That way, it's a win-win-win across the board. And whether that's painting, or whether that's an install of landscaping, or whether that's getting your car maintenance done that you got to get done, those kinds of things can be done today. Maybe not today with the car. I don't know if you can go into a garage now. I don't know what the rules are on that. I don't think it's open, but eventually it will be. And when it is,
sure. Essential services, they've always been open.
Are they? Okay, great.
Garages,
great.
Never shut down.
Never shut down. That's good. But no one's going. So this provides sort of an impetus for people to go and support those local businesses that are going to have a tough time. And now that they have the PPP, they've gotten some support from the federal government that gets forgiven if they keep people on and if they're doing some work. And so that's just, when you think about how all these levers or how these things fit together, it's a pretty complex puzzle. But there's a lot going on, and there is a way to work through this for small businesses. And I've also heard from businesses who didn't get PPP, and for for whatever reason, didn't apply correctly. It was a complex process. Their bank, favored larger companies over their company. They had one of the excluded categories. If you're a bar, you didn't get support. Given those limitations, those businesses have a really hard path. And if you have a favorite bar, you want to support them somehow, because they're not going to make it. They don't have any support from the federal government. But all these things are working together so that when we decide to open up, when we feel safe, the economy is still going. And in the midst, 3-4 weeks ago, you had no idea what was going to come together to make it work. You could still believe that something would come together, but in that moment, and I had those conversations with some of you, I couldn't convince you, but I couldn't convince you what was going to happen, but I could hopefully transfer the belief that something was going to happen. Having walked through these a bunch of times, 2008 being the most recent example, you just know that it's going to resolve, or there's going to be tools put in place, or there's going to be new things that we have to figure out, and we figure it out. Scientists are working around the clock on all the things that are health related. Politicians and economists are working around the clock on how do we keep the economy from folding. And that's, I believe that process continues, and that's continuing around the globe in every economy, in every culture. I note that no additional questions have come in, and I note that we have a few moments left. I'm happy to answer any other questions. There's the Q&A function and the chat function are both there. I do see that we have, is there a raised hand? No, not a raised hand. Okay. David, do you have anything to add? I'm going to put you on the spot.
I keep thinking about the issue that was raised earlier with regard to how the press covers market activity. And I think that they have to say something. They constantly have to say something. And as we know from, I read a lot of history books, when we're going through things that are contemporaneous, we often don't understand what the forces are that drive those things. And it's only when you have hindsight and perspective that certain things become clear. And even then, there are always multiple interpretations. And so I think it's very important that people not get, don't sink into whatever explanation somebody in the media is providing for what's happening, because it's inevitable that it's going to be incomplete and possibly completely wrong. And sometimes people do have insight, but they're going to be able to explain why they have that insight. And you can find, you can figure out whether it's credible or not. So,
well, as one of the owners of Berkeley Side told me a couple of years ago, John, you can find the news that you want.
Yep.
It's out there.
Yep, that's a fact. That's a great statement, John. We did have a question come in, and this is actually a really good question. Business survival is a concern. What about state and local government ability to survive without revenue? How's that going to affect markets? So really, what that will have a muted effect on stock markets. It's going to have a massive effect on municipal bond markets, and so that's why one of the things that the Fed has done, and they've done it twice now, is they've actually put 2 different programs in place to support even low quality, translated into high yield municipal bond markets are being supported by the Fed right now. How they come out of this without this revenue for this 2 or 3 months, and then fill their own holes, that's a question that's being debated. There's a whole school of folks that are saying, hey, how about we give municipalities or states, specifically states, the ability to declare bankruptcy. A lot of people don't know states can't declare bankruptcy. States have to have a budget, and they have to balance their budget, which means they can balance it with debt. But there's a point where, and there's a couple states in the country, Chicago's not a state, but it may as well be. So Illinois is sort of leading in this space. They are trying to raise tax revenue and fees, but they are spending way more money than they bring in on a very regular basis, and their bond prices their bond yields are actually really high, and it's a question: how do they get out of that hole, especially in the coronavirus times? And it's a great question. I actually don't think ultimately it'll have a massive effect on the stock market, because it'll have an effect on small companies locally, maybe to the extent that they're actually providing services to governments. But most companies, like Microsoft, provides a lot of services to government, but Microsoft doesn't need governments to buy the services. Microsoft is global; they're going to be fine. If you have a really small local company that you're invested in, which there are some, and we're invested in small companies, but they're not usually tied to one municipal area. That's really small. There were actually 11 publicly traded small companies in the Bay Area that got PPP money. I think the largest loan in the San Francisco Bay Area was $7.3 million. That's the forgivable kind. So all of those companies have access to the windows that the Fed is providing. States are a unique situation. Again, municipal bond markets are something we're going to be wary of. And we're investors in municipal bonds. We are. And higher quality municipal bonds actually did really well through this. Lower quality municipal bonds didn't do as well, which is what you'd expect. But at the same time, now if you buy high yield municipal bonds now, your interest, your dividend income, which is again tax free, is big, 10, 13, 15%. But you're sort of betting on the ability for the municipality to pay, and that's a big question going forward for sure.
Jonathan, I think the House is certainly looking at the next bill being largely money for state and local shortfalls. And I think despite McConnell's attempt to force Democratic states into bankruptcy so that they can diminish pensions and other things like that, I don't think that's going to be a successful strategy for him. And I do think that the federal government will wind up bailing states and municipalities out.
And the bond market agrees with you entirely. I mean, that's why we actually saw the bond market the municipal bond market get crushed in March, but then like 4 days later, it almost fully recovered. The high quality had fully recovered. So that's the bond market agrees. The bond market is saying that, listen, the federal government's not going to let these municipalities fail, which means, I talked about this earlier, the 3.74 trillion that we've already sort of run as a deficit this year, or already agreed to run as a deficit this year, it may be 4.5 or 5 by the time we're done. And at some point that's theoretically inflationary, but that argument's been made for the last 15 years and not been real, not been true. The economists are going to argue about this a lot. When we're investing in a very broad, diversified, global set of equities, and we're using, high quality fixed income as our ballast, this is going to affect us less. Right? We're broadly diversified. We're not concerned about any specific municipality. There are municipalities that aren't doing as poorly as others. So again, there are the basic tools of investment: asset allocation, diversification is the way we protect against this kind of a thing long term. There's another question that came in that's what about real estate from all this? And I think housing. So this, real estate gets split up in a couple different categories. You get commercial real estate, which includes some larger housing units or some buildings with many units of housing, and then there's also commercial. I think that we may actually see, and I kind of hope for this a little bit, we may see a decline in commercial real estate out of this, because I think that Zoom has actually proven to be incredibly powerful, and I think that commercial lease rates are high right now, especially in our local environment. They're ridiculous.
That's right.
We pay a lot for our rent in our downtown, and we just signed a lease, so we're there for 5 years regardless. I can tell you that many folks, and I have 2 different study groups I'm part of, that have teams much like mine, that have office space much like ours, and they are almost all thinking about what their real estate footprint's going to be. Is it going to change in the next 2, 3, 4, 5 years? I think that's a reasonable conversation. Is there a better way to do it? At the same time, there's also a fear about, these big open environments like WeWork and these big open space environments where people go in and work together. There's a fear that, hey, if I don't have an office wall, someone's going to sneeze and I'm going to get it, and I don't know what it is anymore. And so there's a possible move towards, in some circumstances, using more real estate if you have to have an office space. So I think housing is largely, we don't have enough of it. So I think that's largely, you may have a dip, but it's not going to be a long-term dip. But I think you may see some softness, especially in the Bay Area, around commercial real estate.
Zillow just came out with a story today. It's the first time I've seen someone put numbers to it, and they're talking about like a 2 or 3%. That's it. Yeah. Nationwide decline in residential pricing. But maybe John could speak, if he's talking to Sherry at all, about what she's saying about real estate in the Bay Area, locally in the East Bay. Are they starting to show more, that kind of thing?
Well, I can just speak from experience, since I'm married to a top real estate agent in the area. Mm-hmm. But yeah, she's in this pandemic has had 2 deals that have gone through. Because there are people out there that want to buy. And the case in point was a couple that moved up here from LA. They have a 2-year-old and a 5-year-old, and they needed to get out of the place that they were renting around here and into a house. And they did that 2 weeks ago. There's a few more days until they can get into the house, but that's one. And then actually over the weekend, she got into contract on a house over in Alameda. Again, people that have been looking for a long time. And there is other activity going on out there. They've loosened the restrictions. Landscapers can landscape, painters can paint, and so houses can get prepped for coming onto the market. And she hasn't really seen any price decline yet. While I've got the phone here, you can Google this. Found a very interesting article over the weekend from The Economist online called Death of the Office. Very interesting article. It's kind of got a surprise ending to it. So if anyone's interested, I won't give it away. I thought it was a pretty good article.
I think what John just said about real estate is kind of interesting, because if you talk to your average neighbor, friend, colleague, and et cetera, they're all going to say, who's selling and buying real estate right now? And if you don't know anyone selling or buying real estate, in your mind, real estate's a dead business right now. I think it's really nice for John to say, look, people are selling property, buy property. Yep. Because that's really important to know. There's what people think is going on, and there's the facts.
Right.
So I think that's really helpful and useful for us and everyone on the call. Know that this is starting to pick up again, and people are definitely starting to buy and sell property. That's great. Congratulations on those 2 deals, by the way.
Thank you.
That's nice. John gets to keep eating this year.
Keep
So
putting gas in the car.
right. So we do have a question come in. Do you agree with what I understand Paul Krugman to be saying, namely, there's really no other place of significance to put assets other than the stock market? So that is before Paul. I don't know if that's what Paul Krugman says or not. That before Paul Krugman says that or anyone says that, I believe that already. I mean, I actually think that the only way to invest for a long-term future where we don't know what the inflation is going to look like, we don't know what the world's going to look like, is to find a way to capture the innovation and productive capacity of humans in business. And I think that when you think about it that way, there isn't anything like the stock market. And I'm not talking about just U.S. and John mentioned this earlier. I think global is the way to go, and I think as broadly diversified as possible. And then the question is, and I think maybe what Krugman's talking about, and I didn't read it. So there's three basic places you can put money, right? And people add real estate and commodities on this as well. But I'm gonna talk about three places you can actually allocate capital to. Real estate gets weird because it takes a lot of capital to take down a piece of real estate. It's not liquid. So allocating capital is a different function, but there's three places when you're allocating capital. And I think that two of the three are less attractive, but still important. So the first place you can allocate capital is cash in your bank account. Everyone's got to have a certain amount of that. Every one of our clients, we recommend, you maintain emergency fund, and that's cash on the sidelines. But you have to recognize what the bank does with that cash. The bank takes that cash and lends it out into the market, invests it in different entities and different spaces, and they turn that cash into earnings for their shareholders. Okay, so that's what a bank does. Or you can lend money. You can lend money to governments or companies. And when you lend money to governments and companies, more so companies, is they take that money that you lend them through bond market or what have you, and they take that money and then they build some plant and equipment, or they buy another company, or they basically support their operations, and they create a profit for their shareholders. And then the third thing is you can actually be a shareholder yourself. You own equities, and I'm always going to be a huge supporter or believer in the global equity markets. However, every single person is different. And so there is a certain amount of stuff you need to keep in a fixed income portfolio, high quality fixed income, as a ballast, because the downside of equities is their short-term volatility. And there is no way around that. There's no way to trade around it. There's no way to predict it. There's no way to control it. So you just have to have something that is not tied to equity volatility. So for me, all long-term returns come from equities, and our protection comes from fixed income. You want to add to that, Scott?
I think we just talked about this over the weekend, or maybe it was Friday, but so a stamp 30 years ago was what, John, 25 cents?
Yeah.
And now it's 50 something cents. So it's basically 30 years later, it's doubled. And so that's real inflation, right? That's what it costs. So with interest rates pretty much at zero, how can we secure long-term successful outcomes for clients if the majority of their assets are invested in those types of securities? And the answer is you can't.
Yeah.
You just can't in this environment. It's impossible to do.
Right.
So,
the best long-term return, or the best predictor, I think this is a BlackRock did a long study about this. They said the best long-term predictor of returns in a bond is the bond's coupon, right? So if bonds are paying, as you say, 1%, and inflation is right now, it's not going to be existent. But if you're investing in bonds right now, you're going to hold those bonds to maturity. Inflation is going to be here while you own those bonds, and if bonds are inflation's 2% or 2.5%, or with all this spending, maybe we see a 3%, maybe we see higher. Who knows? But if that happens, the only way to compete, the best way to compete with inflation, is equities.
Diversified portfolio.
Yeah.
Right.
And we've got about 3 minutes left. I'm happy to entertain other questions. I'm happy to say anyone on the call want to state anything else. Feel free. I'm also happy to go have lunch.
Well, so what do we have coming up? Maybe while we have a few folks on the call, maybe let them know what's coming up over the next several business days. They might want to know about
In our own in what we're doing.
Yeah.
So I think the next thing we have is actually Saturday's play. So I hope people are signed up to come to the play. I'm totally blanking on the name of the play, Sarah.
Language Archives by Julia Cho.
Thank you. Language Archives by Julia Cho. It should be fantastic. It actually went not last Saturday, Saturday before last. We did the GOAT, and it was fantastic. It was a lot of fun. But we had 75, 80 people there. Is that right? Something like that. And hopefully we have a whole bunch more people supporting shotgun players. I'm loving it, and we'll probably do that one more time. But I think there's some Zoom fatigue occurring. I think people are, and I've read plenty of articles about this as well. It's tough to sit here on Zoom a lot, but I hope you'll join us for the play, for sure.